How will the early impacts of climate change and the human responses to it begin to make themselves felt over the coming decades? Well, as one feature in the Financial Times last week covered, this is no longer a theoretical question. Specifically, people with property held to be particularly at risk from climate weather events are finding either that their insurance premiums are massively going up, or that they simply can't find people to insure them at all. So, let's have a look. Now, as someone who talks often about climate change, I see all the usual comments beneath those videos, including the ones that go something like, if climate change was real, why would Barack Obama and Al Gore and name your other leftish celebrity have bought an oceanfront property? Since people who leave such comments often don't actually watch the video, wouldn't be entirely surprised if you wouldn't find exactly those comments below this video. And generally, it is just one of those dumb tribal comments. Most coastal areas will see gradually increasing challenges over the course of decades. It all depends how far above sea level the properties are, whether the area is seeing the land sinking or rising, as it sometimes does, depending on where it is, and so on. On standard property value timescales, your average multimillionaire could happily expect decades of enjoyable use of such property, and a lot longer if it's a significant distance above sea level. Which is fine. But of course, there are some places where the properties are not that far above sea level, where the land maybe is stable at best or sinking, and which is seeing already the problem of dealing with, for instance, storm surges approaching more and more. So what about those properties? Well, it seems that some of the people living in those places are starting to learn how the pointy end of this is going to go. So the Financial Times talked about the experience of several people who own seafront properties in Virginia Beach, Miami, a beautiful but rather flat location. For example, one Michael Hefner, a former US Navy officer who lives just a short drive from the seafront and had been there for just a single year before his home insurer just cancelled his coverage. He asked if they would keep him on if he paid more money, and the answer was no. He looks around for a new insurer, preferably for about the same amount he'd already been paying, which was $1,200 a year. He got quotes for around double that, all the way up to $3,200. They also talked about the experience of Chelsea Stoffen, a middle school teacher living in the same area. She had been with her large insurer since 2016, but they dumped her at a month's notice. Local insurance broker Goosehead Insurance told the FT that they had seen this happening all over. Lots of people scrambling for new insurance providers, others having to deal with spiralling rates, a huge jump in people who were calling them for help. Why is this happening now? Well, insurers in Virginia Beach probably had their attention focused by the tornado that ripped through the place last year. But more widely, we have seen a run of 4 consecutive years where overall insurance losses from natural disasters have topped $100 billion. That figure used to be the sort of threshold you passed in a standout bad year, not a normal year. And you've often seen that bad years would be because of a single, or maybe a couple of related disasters that were particularly unfortunate. So 2017 was a recent peak, for instance, for financial losses, largely because of a set of major hurricanes across the United States and the Caribbean, including Hurricane Harvey, which hit Texas and Louisiana at full strength and did huge damage. For insurers, that's just bad luck. But what's freaking some of them out now is the recent years are all hitting high levels. By and large, those numbers are not being inflated by large singular events. Instead, it's just a growing number of certain events that they're seeing more often. And they know that thanks to climate change are only likely to be even more often and worse. Last year, for instance, had a record number of billion-dollar insurance losses from natural catastrophes, 37 of them. Now, a few of those are not climate-related, such as earthquakes, but that's the tiny minority. It included 25 what are called severe convective storms, 21 of which were in the United States. It also included the costs of wildfires associated with heat waves and the like. In the US specifically, big insurers including State Farm and The Hartford have paused underwriting new homes in the state of California. On their website, State Farm say that rapidly growing catastrophe exposure is one of the key reasons for the move. But even places where you might not expect, like the state of Virginia, not a state notorious for massive natural disasters, but high winds and flooding are common, and it's one of the areas that insurers have marked out as a danger spot for the future. Heat waves and consequential wildfires across Europe, particularly in the south, led Lloyd's of London Chief Executive John Neal to warn that insurance prices in Europe would be rising as a result, as was already happening in the US and in Japan. And Neal said this: "The pattern of weather, which is a function of climate change, is changing. I don't think you can simply rely on past data and say that's what happened in the past, so that's what will happen in the future. I think there's a lot more on us to understand what changing weather patterns mean." Of course, there are always people overclaiming about which extreme weather events are being made worse in the current day by climate change. A number of them are not, or at least not yet, and some are not expected to get worse at all. But some of them are, based on recent experience. More heat waves, more floods. People who want to persuade you otherwise can cherry-pick various graphs or take things out of context, as they do, but the people who stand to make or lose billions of dollars by making the right call, they're going to go by the actual evidence. And the data shows a significant upwards trend in the US and Europe of insurance claims against disasters. And the growth is significant even if you account for example, inflation in rebuilding costs. So look, skeptics, if you're right and climate change is never going to get any worse, there's a great business opportunity right there. Step in, provide low-cost insurance to the folks being abandoned by the others in the industry. What could possibly go wrong? In fact, many in the insurance industry are beating themselves, or at least each other, up because they argue that they've been too slow to build climate into their risk management approaches. They suggest that the risk modelling companies they relied on had not built in sufficient weight for climate change. The chief executive of one major insurer told VFT the insurance industry had its head in the sand around climate change. It's a gigantic pain and it tried to avoid it. It will spend the next few years looking at it and it will figure out how to do things better. What will that look like? Well, higher prices for some. Insurance giant Swiss Re has suggested that there will be growing patches where people will simply find buying insurance to be unaffordable. Obviously, at least some legislators will think that's an unacceptable outcome, so you can expect proposed policies to deal with that to varying degrees of effectiveness. It may end up that the taxpayer becomes the maybe reluctant insurer of last resort to such places, depending on who you vote for. There are some state-backed insurers, of course, such as Florida's insurer of last resort, Citizens, currently supporting 1.2 million policyholders. Now, it's not so certain that this just goes south in a single unbroken line. States can, after all, invest in flood defences and other measures that might change the risk profile for certain areas. And should there be a couple of years where the losses are significantly below that high number of recent years, maybe that will start to adjust sentiment about where the line should actually be drawn. But this is not going to go away. The Bank of England warned 3 years ago that if governments across the world fail to prevent global warming from reaching 3.3 degrees Celsius above pre-industrial temperatures by 2050, that would be likely to render around 7% of existing UK households uninsurable. That's a prediction that has a pretty big if attached. 3.3 is at the top end of the scale of what we think might realistically happen, but it gives you the sense of the scale of potential risk. Insurers are trying to work out what subset of that is the real risk that will be the difference for them between profit and loss. In the meantime, you'll also see governments flirting more with the idea of doing things like banning new house building on floodplains and investing in new flood defences and forest management, which is what you would expect to happen. Not all such problems should be solved by the private sector insurance market, after all.